Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's talk about something that can really hit your bottom line, the annual IRS mileage rates. Every year they release these numbers, and if you drive for your business, for medical appointments, or for charity, you're going to want to pay attention. So let's break down what the new 2026 rates really mean for you. I mean, think about it. Could that trip to a client or that drive to pick up supplies actually put money back in your pocket at tax time? The answer is a big yes, but you have to know the rules. For the self-employed, small business owners, and a few others, those miles you're putting on your car can add up to some serious deductions. Let's see how.
Okay, let's not waste any time. We're diving right into the numbers you've been waiting for. These are the official IRS Standard Mileage Rates that will kick in on January 1st, 2026.
First up, the big one, the one most of you are probably here for, the business rate. For 2026, it's getting a bump up to 72.5 cents per mile. That's an increase of 2.5 cents from 2025, and it's meant to reflect the very real rising costs of keeping a car on the road. Now here's a little twist. For medical travel and for those very specific qualified moving expenses, the rate is actually going down a little bit to 20.5 cents per mile. And I have to stress that moving deduction is extremely limited these days. We'll get into exactly who qualifies in just a minute. And rounding out the trio, if you're driving for a charity, the rate is holding steady. No changes here. It's staying put at 14 cents per mile. So let's just put that all on one screen. Business is up, medical and moving are slightly down, and charitable is staying the same. But have you ever stopped to wonder why? How does the IRS come up with these numbers? It's not random. Let's pull back the curtain. So let's zoom in on that business rate. Why exactly 72.5 cents? Well, like I said, it's not just a number they pull out of a hat. There's a whole study behind it. You know, it's so easy to think this is all about the price of gas, but that's just the tip of the iceberg. The IRS looks at the whole shebang. They factor in what they call fixed costs, things like your insurance, registration, stuff you pay no matter how much you drive. And then they add in the variable costs. Fuel, yes, but also maintenance, tires, oil, and one really big one, depreciation. Okay, this is a super important point that a lot of people miss. Of that 72.5 cent rate, a full 35 cents of it is for depreciation. Think of it like this. It's the IRS's way of recognizing that every business mile you drive is causing a little bit of wear and tear, making your car worth just a little bit less. It's a non-cash expense, but it's a huge part of the calculation. All right, so that explains the business rate. But what about the other two? Why are they so different? Well, they're calculated in a completely different way, and for good reason. Let's check it out. So the reason the medical and moving rate is so much lower is simple. It only includes the variable costs. It's basically just what it costs you to run the car at that moment, like gas and oil. It does not include those fixed costs, like insurance, or that big depreciation piece we just talked about. And about moving, I told you it was narrow. This deduction is now pretty much only for active duty members of the armed forces who are moving because of a military order and certain members of the intelligence community. That's it. And then you have the charitable rate, which is the real oddball of the group. Why doesn't this one ever seem to change? Because it's literally set by Congress. It's written into the tax law. It has nothing to do with that annual cost study. So until a new law is passed, 14 cents is where it's going to stay. Okay, we've got the rates. We understand the why behind them. Now we get to maybe the most important part of all. Can you actually claim this deduction? Because the rules here have changed a lot. So let me be crystal clear about this, because this is the number one point of confusion. If you are a regular employee, you get a W-2 from your job, you generally cannot deduct your business mileage anymore, even if your boss doesn't pay you back for it. This deduction, for the most part, is now for self-employed individuals and business owners. But, you know, it's the IRS, so of course there are a few exceptions to the rule. If you're an armed forces reservist, a government official paid on a fee basis, a qualifying performing artist, or an eligible educator, you might still be in luck. But for most W-2 employees, this deduction is off the table. Now, let's say you are eligible. You're self-employed, driving all over town. You still have a big choice to make. You don't have to use these standard rates. The IRS gives you another option. You can calculate the actual costs of using your car. And this decision leads us to our final and maybe most critical section. So which way do you go? The simple standard rate or the more complicated actual expenses method? This is a huge decision, and the right answer really depends on your specific situation. So here's the fundamental trade-off. The standard rate is all about simplicity. You log your business miles, you multiply by the rate, and bam, you're done. Less headache, less paperwork. The actual expenses method, it's a lot more work. You have to keep meticulous records of everything. Every gas receipt, your insurance bills, new tires, repairs, all of it. But, and this is a big but, for some people, especially if you have a more expensive car or high maintenance costs, it can result in a much bigger deduction. Okay, if you own your car, I need you to lean in and listen to this because it is absolutely critical. It's called the first-year rule, and it can't be undone. In the very first year you use a car for business, you have to pick a lane. If you choose a standard rate, you keep your options open. You can switch to the actual expenses method down the road. But if you start with actual expenses in that first year, you are locked out of the standard rate for that car forever. It's a one-way street. You can never switch back. So you have to choose wisely right from the start. And what if you lease your car? The rule is a little simpler, but just as binding. If you choose the standard mileage rate, you have to stick with it for the entire life of that lease, and that includes any renewals. No switching back and forth. You make one choice, and you're done. Wow, that was a lot of ground to cover. So let's just boil it down to the absolute must-knows. 1. The 2026 business rate is 72.5 cents a mile. 2. This deduction is mainly for the self-employed, not most W-2 employees. And 3, that first-year choice between the standard rate and actual costs is a really, really big deal. Choose wisely. And all of this brings us right back to the beginning. Knowing the rates is one thing, but actually putting that knowledge to work is another. Every trip to a client, every run to the post office for your business, it all adds up. So with these new rates in mind, the real question is, are you leaving money on the table